Viewers at home, you are welcome to my presentation on capital allowance. This is the continuation of the earlier presentation. In this presentation, I will specifically examine the treatment of one, existing asset, that is an old asset in capital allowances. Two, disposal of an existing asset. Disposal of an existing asset in capital allowances. These are my focus. I will advise you watch my earlier presentation for better understanding. Check the description to this video for the link to the first video, or just search ICAN capital allowance. So, now what are the steps for the disposal of an asset? Where there are disposal of asset, or where you have an existing asset, what are the steps you need to follow in the computation of capital allowances? Steps. Number one, you identify the basis period for the capital allowance. Number one, identify the basis period for capital allowances. Or let me say, for the qualifying capital expenditure. Let me say, it is still okay for capital allowances. You identify the basis period for capital allowances purpose. That is, you align the qualifying capital expenditure with your basis period. Step 2, compute the tax written down value. Compute the tax written down value. Tax written down value, TWD, of the existing asset at the date of disposal, where this is not given. Step 3. Step 3. Identify the unexpired life of the remaining asset. Identify the unexpired life of the remaining existing asset, and use this to compute its annual allowances. So use this to compute the annual allowances of the existing assets. Step 4, compute the capital allowances for all relevant years of assessment. These are the steps you need to follow when existing assets and the disposal of existing assets are involved. Example, manufacturing company PLC has been in business for several years. Financial statements are made up to June 30 every year. Accounting year end of the entity is 30th of June. The following acquisitions of property, plant and equipment were effected in the year ended June 30, 2014. That means the acquisition was made as at 30th of June 2014 accounting period. Industrial buildings is 5 million. Plant and machinery of 1,750,000. Motor vehicles of 3.5 million naira. The following disposals were made during the same year. Motor vehicles acquired for 1.5 million naira in the year ended 30th of June 2012 was sold for 2 million naira. It was acquired for 1.5 million and was sold for 2 million. The residues of qualifying expenditure as at July 1st, 2013 were industrial building, 5 years more, which is 10 million naira. That is the residue. These are the existing assets as at 1st of July 2013. Remember, part of it, motor vehicle was sold. And this vehicle has been bought since 2012 accounting period. And it was sold during this period. Industrial building, 5 years more. Plant and machinery, 2 years more, 2 million naira. Motor vehicles, 2 years more, 3 million naira required. Compute the capital allowances for the relevant assessment years. So that is the question. Now let's have the solution. The first thing is to identify the basis period for capital allowance. No, these assets were acquired in 2014 tax year. So you need the basis period that will be in line with this period, since this is the year end. So you want it to end as at 30th of June. Let me say basis period for capital allowances. So year of assessment, basis period, then we have qualifying capital expenditure. So the basis period for the year ended 30th of June 2014 will form part of 2015 year of assessment, since the core principle is preceding year basis. So we have 2015. The basis period, you want it to end as at 30th of June 2014. That means the period must have started from 1st of July 2013 to make it exactly 12 months. From July 1st, 2013 to 30th of June 2014 is 1 year. So which is, no, this period is not yet in line with Finance Act, but the principle will not be different from that of the Finance Act, since it is an existing business. No, we only have difference in commencement principles and cessation in Finance Act. So, but since it is an existing business, the method or the computation will not be different from what is obtainable in Finance Act. So the business have been in manufacturing business for several years. So it is an existing business. The principle is preceding year. So these assets that were acquired in June 30, 2014, they will all qualify in 2015 year of assessment. That is your industrial building, which was acquired, then the plant and machinery, and motor vehicles. They will all qualify in 2015 year of assessment. That means our computation will be for 2015 year of assessment. If you look at the question required, compute the capital allowances for the relevant years of assessment, relevant assessment years. So that means the relevant assessment years now must be 2015 year of assessment. So if you put computation of capital allowance for relevant assessment years, you've scored 0. So the year of assessment have to be stated. So that means your answer should be computation of capital allowance for 2015 year of assessment. What is the name of the entity in question? We have Manufacturing Company PLC. Now, manufacturing company PSC. We now have computation of capital allowances for 2015 year of assessment. Remember, the examiner put for relevant years of assessment. So you have to state the year of assessment. So we have industrial building, industrial building. We have plant and machinery. We also have motor vehicles. So we have initial allowance rate. Initial allowance. For building, we have 15%. For plant and machinery, it is 50%. For motor vehicle, it is 50%. Then we also have annual allowance. For building, it is 10%. Then for plant and machinery, 25%. Motor vehicles, 25%. Then we also have investment allowance. That is claimable on plant and machinery, and that is 10%. So then we have capital allowance for the year. So you start with the existing asset. So, this is 2015 year of assessment. Tax written down value of the existing asset. Now, you were told the following disposals were made during the same year. These are the disposals which were made. Motor vehicles acquired for 1.5 million in the year ended 30th of June 2012 was sold for 2 million. This is a disposal. This is the proceed of the vehicle disposed. And this is the cost. And besides, the difference between the tax written down value and the proceed ought to be either the balancing allowance or balancing charge. But this one now, the proceed is even greater than the cost at the time of acquisition. So that means this 2 million will not be relevant. You are not going to have balancing charge. Neither will you have balancing allowance, where the proceed is greater than the cost at the time of acquisition. So you only have balancing difference. And the balancing difference is not relevant in tax. We only have balancing charge, which will be excess of the sales proceed over the tax written down value. Tax written down value is different from the cost. While balancing allowance is the excess of the tax written down value over the sales proceed. I repeat, balancing charge, excess of sales proceed over the tax written down value. While balancing allowance, excess of the tax written down value over the sales proceed. I've told you that where the sales proceed is greater than the cost at the time of the acquisition, you are neither going to have balancing charge nor balancing allowance. So in that case, the proceed of 2 million will be useless because it is greater than the cost at the time of acquisition. Now, the residues of qualifying expenditure as of 1st of July 2013 were, remember, July 1st, 2013 is part, if you look at 2015 year of assessment, it started from 1st of July 2013 and it ended as at 30th of June 2014. That means 1st of July 2013 is part of 2015 year of assessment. That means the qualifying capital expenditure, the residue you are given here, they add the residue as at the beginning of 2015 year of assessment. Since July 2013, it's part of the 2015 year of assessment. So you have industrial building. So we have tax written down value, industrial building, and that is 10 million. 10 million. Let me add 3 zeros here. So 10,000. Then the tax written down value of plant and machinery is 2 million. 2 million. 2,000. And the tax written down value of motor vehicle is 3 million. 3 million. Now, remember you were told motor vehicle which was acquired were also sold in this period. So that means you need the tax written down value. The one disposed is part of this. The tax written down value of the motor vehicle sold, that is the motor vehicle disposed, its tax written down value is part of this 3 million. So therefore, you will need to remove the tax written down value of the motor vehicle disposed from the 3 million to get the tax written down value of the remaining motor vehicles which have not been sold. So that is why you will need to compute the tax written down value of the motor vehicle disposed at the date of disposal. So that is what we need now. Let's go and compute that. The following disposals were made during the same year. The motor vehicles acquired for 1.5 million in the year ended 30th of June 2012. June 2012 30, since the core principle is preceding year, that means June 30, 2012 will be part of 2013 year of assessment. Since it will be part of 2013 year of assessment, that means this motor vehicle must have qualified in 2013 year of assessment. Please do me a favor. Try to share this video on other social media platforms so that the video will be able to go viral. Also share it with your friends. So now, I said this motor vehicle will have qualified in 2013 year of assessment, since this period, the time of its acquisition is for the year ended 30th of June 2012, and the principal is 2013. So that means you have year of assessment 2013. Remember, the basis period for 2013 year of assessment since the accounting year end is 30th of June 2012. This is 30th of June 2012. It will have started from 1st of July 2011. So, which will mark it exactly 12 months. You have motor vehicle was acquired. Let me have disposal of motor vehicles. During 2013, it was 1.5 million naira. It was acquired for 1.5 million in 2013 year of assessment. That is the year end, which was 2012. So 1.5 million. You know, the initial allowance rate for motor vehicle is 50%. 50% of 1.5 million. That will be 750,000. 750,000. And we say annual allowance will be calculated on the residue, which is cost 1.5 million minus initial allowance, which is 750,000, divided by the estimated useful life. The annual allowance rate on motor vehicle is 25%. Therefore, the life of this motor vehicle will be 100 over 25, which is 4 years. The vehicle is expected to last for 4 years, so divided by 4. So 1.5 million minus 750,000, that will be 750,000. 750,000 divided by 4. Therefore, the annual allowance will be 187,500. So the tax written down value in 2014 year of assessment now, we have the tax written down value at the beginning for 2014. So if you supply both the initial allowance and the annual allowance, if you subtract it from the cost of 1.5 million, then you have the tax written down value to be 562,500. Now, out of 4 years, the life of the motor vehicle is 4 years. 1 year has expired. 2013 has expired from 4 years. Therefore, 4 minus 1, 1 year that has expired. If you have 4 minus 1, you'll be left with 3. Therefore, the annual allowance in 2014 now will be 562,500 divided by 3. Divided by 3. That will also give you 187,500. So, in 2015 now, at the beginning of 2015, so you have the tax written down value. So if you subtract this, then you are left with 375,000. This is the tax written down value at the beginning of 2015 year of assessment. And our year of assessment in question is 2015. So you now go back here. So since year of assessment is 2015, you have disposal. The tax written down value of motor vehicle disposed is 375,000. So you remove the 375,000 from all the motor vehicles you have, so as to get the tax written down value of the remaining motor vehicle. The one disposed 375, we have removed it from 2 million. So that means the remaining motor vehicle is 6 million, 2,625,000. So that is the vehicle that have not been sold. The one that have been sold, you have removed them. So these are the remaining assets you have, the remaining ones from the existing assets. Now, in 2015, you have addition. Addition means those ones that were just acquired during the year. So, back to the question. Industrial building acquired during 2015 year of assessment, the cost is 5 million. So we have 5 million for industrial building. So 5 million. Then for plant and machinery, the one acquired is 1,750,000. So 1,750,000. Then for motor vehicles, the one acquired during the year is 3.5 million. So 3.5 million. So if you add it, so it's 15 million. This will be 3,750,000. If you sum up this, 5, 2, 11, 6. So you can only claim initial allowance on the new ones. So we have initial allowance. Note the initial allowance rate for industrial building is 15%. And the addition is 5 million. Calculate 15%. 15% of 5 million. That gives us 750,000. That is the initial allowance on industrial building. On plant and machinery, the addition is 1,750,000. Let me work it here. Initial allowances. So we have industrial building, which is 15% of the addition is 5 million. 5 million. That gives us 15% of 5 million. That is 750,000. Then we also have plant and machinery. Plant and machinery. The initial allowance rate is 50%. 50% of the cost. The addition is 1,750,000. 750,000. So 50% of 1,750,000. That gives us 875,000. Then we also have motor vehicles. Motor vehicles. The initial allowance rate is 50%. The addition is 3.5 million. 3.5 million. So 50% of 3.5 million. So we have 1,750,000. 1,750,000. So for plant and machinery, we got 875,000. For motor vehicle, 1,750,000. 875, 1,750,000. If you sum up all your initial allowances, 750 for building plus 875 for plant and machinery plus 1,750 for motor vehicles, and that is total 3,375,000. That is the initial allowances. Then we have annual allowance. Annual allowances. You compute the annual allowance on the existing. So let me have annual allowances. So number one, we have building, that is industrial building. This building, we have the existing, that is the old one. Existing. The existing building, the cost, the tax receivable value is 10 million. 10 million. And it has 5 years more. Meaning that the unexpired life of industrial building is 5 years divided by 5. Therefore, the annual allowance on industrial building will be 2 million on the existing one. Then on the new one, the one that is acquired during the year. To compute the annual allowance, we have the cost minus initial allowance. The cost is 5 million, initial allowance is 750,000. So we have 5 million minus 750,000 divided by, since building is estimated to last for 10 years. 10 years. I mean, the initial annual allowance rate is 10%. If you have 100 over annual allowance rate, which is 10, that means building is estimated to last for 10 years. 100 divided by 10, that would be 10. So building is expected to last for 10 years. So we have over 10. So 5 million minus 750,000 divided by 10 years. The annual allowance rate on the new building is 425,000. 425,000. Therefore, the total annual allowances for the year. Okay, let me separate it. Let me have old and new. The old building, the annual allowance is 2 million. If you like, you can sum it up. If you add the two together, it will be 2,425,000. The addition of the two. But I'm separating them. Old, the new is 425,000. That is the annual allowance for building. Then we also have plant and machinery. Plant and machinery. We have for the old. The tax receivable value of the existing plant and machinery is 2 million. 2 million. And that is given. 2 million. And it's had 2 years more. So we divide it by 2. 2 million divided by 2, that will give us 1 million. So that means the annual allowance on the old plant and machinery is 1 million. Then the new, the cost of the new is 1,750,000 minus initial allowance as computed, which is 875,000. 875,000. And plant and machinery, since the 100 divided by 25, that will be 4. That means it is estimated to last for 4 years. So divided by 4. So 1,750,000 minus 875,000 divided by 4. Then 218,750. 218,750. If you add it together, you get 1,218,750. But let me separate it. Old is 1 million. The new is 218.75. 218,700. Motor vehicles. Remember, we were having 3 million as the tax written down value of all the motor vehicles. Out of it, we removed the tax written down value of the one disposed, which is 375,000. And we were left with 2,625,000. So now let's compute the annual allowance on the motor vehicles. Motor vehicles. Let me have old. You are using the remaining one, not the total of 3 million. 2,625,000. 2,625,000. And you were told that motor vehicles still have 2 years more. So we have divided by 2. 2,625,000 divided by 2. So you have 1,312,500. So the old one is 1,312,500. Then the new one, the new motor vehicle, the cost is 3.5 million. The cost is 3.5 million. The initial allowance is 1,750,000. So we have 3.5 million minus 1,750,000. Since the annual allowance rate on the motor vehicle is 25%, therefore 100 divided by 25, that will be 4. That means motor vehicle is estimated to last for 4 years, divided by 4. So which will give us 437,500. 437,437.5. Now let me sum up this. This plus this, that will be 3 million. Plus 1 million plus, that is 4,312,500. 4,312.5. Then for the new one, 425 plus 218.75 plus 437.5. You have 1,081,250.25. If you add this plus 4,312.5 plus 3,375, then you have 8,768.75. Then you can only claim investment allowance on plant and machinery. Investment allowance of 10% of the cost of plant and machinery. The cost of the new plant and machinery is 1,750,000. 10% of 1,750,000 will give us 175,000. 175. So if you add it plus 175, that is total 8,943,750. This is the capital allowance for the year. So you can now compute the tax written down value. But note, when computing the tax written down value on plant and machinery, we don't use to consider the investment allowance. So now 50 million minus 750 minus 2,000 minus 425. So we have 11,825,000. This is the tax written down value of industrial building. Plant and machinery 3,750,000 minus 875 minus 1,000 minus 218.75. I've told you that we don't used to consider the investment allowance. So we have 1,656,250. Then for motor vehicles, 6,125 minus 1,750 minus 1,312.5 minus 437.5. That gives us 2,625. So that is the capital allowance computation, where there is a disposal and an existing asset. Please, if you are just coming across this channel for the first time, don't forget to subscribe. Also like the video and share it with others. Thanks for watching ICAN. Expect more from me from time to time.